All right, let's what I want to talk about today. Go back into, this is a basic course. Okay, this is just a course for people who may have heard about options. Maybe they know what a call is. Maybe they know what a put is. Maybe they don't. Maybe they've got a little bit of experience, not a lot. Part-time traders. It's a very basic course. So one of the things I want to talk about today, and it's something that a lot of people get involved with options initially because they own stocks. Like maybe they have an IRA or a 401k or mutual funds or whatever, or they just have a brokerage account where they like to, buy and sell stocks. So that's a natural lead-in to options. And so one of the things I wanted to talk about was covered calls. It's a thing that most, well, not most, but a lot of stock traders get involved with when they own a stock. Is that they get involved in covered calls, and basically what that is that's where you own a stock and then you sell a call against that stock to collect the time premium of the call. And I'm going to show you some examples of that in just a second. Then I'm going to show you how you can actually save money. Instead of buying the stock itself, you can just do a surrogate position in options straight away for a lot less money. So what I wanted to do, and we're not going to talk about the markets and how they're down and, elections and all that stuff. We just went through that in our options trading room. So I'm not going to get involved in all of that stuff today. So let's just talk about, I'm going to go down here and I'm going to go to, and it could be any stock, but I don't know. For some reason, I've got this affinity for Buffalo Wild Wings. Probably because I love hot wings so much. Okay, so, okay, I'm going to make this a different size screen here so that we can just concentrate on it. Okay, now, this is, what you see on your screen right here is Buffalo Wild Wings. You'll see that this is the symbol, BWLD. This is a common stock. Now, this little panel up here is the quotes. This is today's, prices. This legend right here to the right of it shows you what these fields mean as we go through here. So you'll see that this is the last price of Buffalo Wild Wings as it's trading today. The change it's down to. This little trade column, which is, there's nothing there. If we wanted to trade the stock, we could just plug in how much right there. I've already set up a trade to show you. Today's high was 76.43. Today's low was 74.25. And we have an existing position of long 500 stock. Now, this is hypothetical for an example. Okay. Now, this matrix that you see here is the options that are associated with Buffalo Wild Wings. You'll notice first across the top, you'll notice that we have these headings, which I'm highlighting. Okay, let's go back to the first one. November, 10 days. See that little 10? That means that the November options have 10 days of life left on them. And then they're going to go poof. They're going to be gone. They're going to expire. December options have 45 days of life left on them. And March has 129 days of life for the options. So all options expire. They expire at different times. And this gives you a quick reference as to how many days are left to expiration in the options. Now, we're going to forget about November, and we're just going to look at December right here. Now, let's suppose, for instance, that you also like Buffalo Wild Wings, and you say to yourself, man, I want to buy some of that. And let's suppose, I'm going to show you a chart. Let me move some of this stuff out of my way. Okay, I want to show you a chart. Now, this is that little red line right here that I just highlighted with this blue vertical line. That's today's price bar. Not. Let me get rid of that. Right here. Okay, now, let's take a hypothetical example and say that long about, right in through here, let's say you decided to buy Buffalo Wild Wings because you thought it was going up, probably on that day right there. So what I did was I went back into and I went back into that time frame, and I bought 500 shares hypothetically, and I did it on August 28th. Okay. So the position, I'm going to go into what I call, this is back trader mode. I'm going to go back in time to 08. Was it 28? August 28th? Yeah. Okay, I'm going to go back to August 28th, and I'm going to get all the price action and everything from that day. Okay, so on this day, you see this 500 shares right here. Let's say you decided to buy Buffalo Wild Wings. Whoops, just a second. Don't want to do that. I want to go with my existing trade, which is just this. I don't want to talk about the options yet. Okay, so existing, if you're long 500 shares of Buffalo Wild Wings, I mean, you can pretty much guess that you're, you know what, I need to make this bigger. Okay. You can pretty much guess that that's the way that things are going to operate. You own it. If the stock goes up, you're going to make money. If it goes down, you're going to lose money. Right? Okay, enough said. Now, let's suppose that you were of the mindset where you said, I think the market's going to go up. I want to buy the stock, but man, I don't want to lose money if it goes down. Or I don't want to lose a lot. Or I want to mitigate some of my potential losses if the market goes down. Well, there's a few things that you could do. Okay, now the first thing that somebody does in this situation is they say, well, if you look at these options right here, and I've got this is a surrogate position. I need to, hold on a minute. Bear with me for a second here. The 80 calls plus 5 and the 65 puts minus 5. Okay. What you might want to do here is the stock's at $77. What if you were to sell 5? Let's get rid of that. This is a call. If you notice that this little line right here in the middle of this matrix separates the calls on the top side from the puts on the downside. So if you look at this strike right here, I'm just going to follow it all the way back over here to the legend. You'll see that this says 85C. Okay, what that means is that this is the December 85 call. So the strike price is 85. Now the market's at 77. So this is 8 points higher, or 7.5 points higher for the call. So if you were to sell 5 at a market price of 290, okay, this is equals the same amount of stock. So one option is 100 shares. Okay, so short 5 is 500, which you're long. You own 500 shares. So you're going to sell a call. Now, the short answer to this equation is that if the market stays below $85 prior to the expiration of the options, you're going to gain all of this $2.90. Well, what's $2.90 times 500? Well, 2.90 times 500 is $1,450. So in theory, or in essence, let's say that Buffalo Wild Wings, moved up $1, down $1, and back and forth for some period of time and didn't really go anywhere. Well, you would gain this amount of money and you wouldn't lose any money on your stock. So it'd look like this. sorry. It would look like this. Now, this is the graph with the stock. So what you're selling a covered call. You're selling premium in the calls. And if the market goes up, you're still going to make money because you're long the stock, you own the stock, and you're also collecting the premium that you're selling the call for. Now, the difference is on this downside. Let's go back and look at what the existing position is when you just own the stock. Okay, that's your position if you just own the stock. I'm going to superimpose the other position, which is green. Now, you'll notice they have the same trajectory. There's only one little difference. Well, there's a big difference if the market really rallies, but the difference is if the market just goes nowhere or goes down a little bit. I'm going to zoom this in. Green is selling the call, and that's probably not the perfect strike you could sell. You could probably do it a little bit different. But you'll notice that this green line is at expiration of the calls. This blue line is just your today line for owning the stock. So what happens is you basically give yourself a little bit more room to the downside without losing money over time. So you're collecting some premium, and your trade-off is that if the market really, really rallies, your gains are going to be capped versus unlimited. Now, would I do that particular trade? Maybe not. I'd probably go in here and pick a different strike. Well, certainly I would pick it. I wouldn't pick it this far out. I'd pick it in probably either September or October. But I had it set up in December to show you something currently. Now, there's a way that you, hold on, I had a question. Got a question. Brian Flam, wouldn't it be safer to sell the front month? Well, yeah. I mean, typically that's what you would want to do. But you're going to have to sell the 80, the 80 call and get 90 cents for it. Or you could sell the oct, 80 or so forth. So there's different ways you can do it. Most people sell the front month and they just keep rolling it and rolling it. Let's look at the difference. Okay, that would be selling the front month. So you don't really get a lot of protection for 90 cents. So why would somebody do that? Well, what if they sold 10? Oh, that's 15. What if they sold 10 against their 500, shares? Now it starts to look like that. Okay, so you can see that you can change your graphs and your potential profit and loss a lot. But now that's getting into something that we don't want to talk about today, so I shouldn't go there. What I really wanted to discuss was, let's say you bought Buffalo Wild Wings back here. This is really what I wanted to go into. Let's say you bought it here and you plan on owning it for a while and you think the market's going to go up. Okay, now this is in August. So what we're going to do is we're going to fast forward. Let's say you bought that 500 shares. First of all, keep in mind how much it's going to cost you to buy 500 shares of that stock. Even if you have a margin, if you can borrow on margin in your stock trading account, if you just use the cash equivalent, it's going to cost, some $30-something thousand just to buy that 500 shares. But I'll show you how you can do it for about $3,000, like a lot less. Okay, so let's close this for a second, and let's go to today. Actually, I don't want to go to today. I wanted to go right before this earnings announcement. Okay, let's say that you'd bought the stock, which we did back here, and the market rallied. Now, you know that an earnings announcement is forthcoming, and let's say you'd made these gains and you want to protect it. And let's say that on this day, when the market went down like that, you said, wow, I've got some nice gains here. I want to try to protect it, but I don't want to sell Buffalo Wild Wings because it's in my IRA. I don't want to pay taxes, blah, 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 whatever your case may be. Okay, so let's go to this day is October the 18th. All right, let's go back here. Let's go back to our back trader, and let's go to 10, 18, 12. And let's see what was happening at the time. Okay. Let's go and look at your existing position, your long 500 shares of stock. This little black dot shows you where you are in terms of your current gain on this stock since you bought it. So it's been going up, right? All right, so you're thinking to yourself, man, earnings are coming up. I hope they're going to be good, but what if they're bad? You know, I don't want the market to go down, and I don't want to lose money or give up my gains. What can I do if I don't want to sell the stock? Well, let's get rid of, hold on a second. Clear my trades. Okay. Well, you could come in here and do the covered call, for instance. And let's just talk about the front month. 90, we're at 86. That's a little bit shy. Let's say you want to sell 5 of the 95 calls. So that means that's 9 points out of the money, you know, and it would look like this. I did it again. Hold on. Sorry. There we go. Okay, it would look like this. You've already made $4,400 on your stock. If the market continues to go up, you'll continue to make money. This line right here, the solid line, is at expiration of the option. This line, the first dashed line, is today on our graph. This one, this next dashed line, is 15 days later. So that just gives you an indication of what would happen in terms of price. If the market, by the way, I was neglecting to tell you that on the price scale, to the right of here, this direction, means that the market price is going up. To the left means it's going down. Should have indicated that. You can see that down here on the bottom scale. It's just a vertical price chart turned horizontal. So, you know, you could see that this could happen here. And it gives you a little bit of extra room to the downside if the market goes down, because you're selling this and you're getting $1.85. So you're getting what, $700 in premium roughly for that. So that's what a lot of traders do. They say, well, I'm just going to sell some covered calls. If the market goes up, I'm still going to make money. If it goes down, I might make a little less, but it'll help me out. Well, yeah, but the problem with this is that the market can still go down a lot, and you could still be back to zero if the market goes down. Now, let's say that you think you're not sure what's going to happen with earnings, but you want to keep your money in your position the way it is, and you don't want to sell your stock, and you don't want to be subject to some rogue move in the market. What could you do? Well, a couple things you could do. You could actually, in the same month, you could sell the call and you could buy the put. So you're selling 5 of these things up here, and you're buying 5 of these things down here. Now you notice that the price you're selling is about $1.85, and this is about $1.80. What would that look like? What would happen? Okay, well now it looks like that. Let me zoom that out just a bit. You'll see what happens in this case is that you still are long your stock, so you have the same potential to make money just as if you never bought or sold any options. But you've done something very important, and that is that if the market goes down, like if, say, the earnings are bad, you've capped your losses to right here on this flat line. So the most you could lose if you stayed with your position and the market had a bad earnings report or the stock, you're going to only, you've capped your loss. But you still have the potential gains. Now, what does that look like against just your actual position? Well, let's go look at your existing position, which is 500 shares of stock. There's your, existing position. What does that look like compared to the other thing? Like that. Let's zoom in on that for a minute. Okay, I want you to take a good look at this. Which one of these positions do you think is superior going into an earnings report? This red line right here represents the linear aspect of just owning the stock, up and down. The blue line, don't worry about these dashed lines because that's just step-through dates, shows you how it behaves over a period of time. This is expiration. Now notice it's exactly the same right through here, but here's where it gets different. You have a maximum loss, you're capped in case of some monster move down, or what happens if Buffalo Wild Wings, all of a sudden the CEO resigns because there was some irregularities of some sort. Okay, so you get my drift. So what happens to the upside is right up here. Instead of continuing linear, you're capped. But you're not capped forever. You could always just close those options and continue to ride this thing up. But you see that this little purple line right here at the bottom, this purple line represents what the expected move or range of Buffalo Wild Wings is over the next 30 days. So it tells you that the expected move can be up right here on this price scale and down to about right here. So my point is that in doing this, you cover your downside maximum loss. And if the market rallies on the news, you're likely to wind up at the same spot anyway. Okay, I saw a question come through. Hey, Brian, I am lost looking at that chart. You're talking about this graph right here? Yeah, I guess you are. Okay, let me explain it a little bit more. Okay, let me go back. Okay, yeah, first time. That's fine. That's what this class is for. Okay. If you look over here to the left, I've just highlighted up here to the left, 500 shares of Buffalo Wild Wings. Let's say you own that or you bought it, previously, whatever. Now there's an earnings announcement coming up. Here's what your graph looks like. Okay. This, remember we bought this like back in August initially. As an example, we bought it in August and the market has rallied since then. So here's a price chart. We actually bought it like right back here in this area, hypothetically, okay? And then the market, went up, and then it did this, and we're starting to say, wow, there's an earnings report coming up. Maybe I want to protect my profit, okay? If we go to this graph right here, see this black solid line right here where I'm moving my mouse? Okay, that black solid line is at 0 if you look over here to the left. Okay, everything above that black solid line represents profit in the position. Everything below that black solid line indicates a loss of money by owning that stock. Right now, that little black dot that I'm pointing at right there, hold on, that one, it indicates that since we bought that stock, we've made $4,400 in profit. This purple line indicates if the market continues to go up, you're going to continue to make money in the stock. If the market goes down, you're going to lose money. So you can equate this if you just take it right across here to these numbers. This is $1,000, $2,000, $3,000, $4,000, $5,000. And over here to the right is just, your percent return that you've made. So this represents what it looks like if you buy a stock. I mean, you're either going to make money or lose money if it goes up or down. There's really no in between. Now, this matrix right here, we're talking about the November options. So these prices right here, market price, the price of a $95 call. Now that call is $95, so the strike price is $95, which I'll have to explain in detail what a strike price is. But let's suffice it to say right now that if you pay $1.85 for a November option, a 95 call, the market, you get to own that stock at $95 a share anytime between now and expiration. But you're only going to want to own it if it goes above $95. But it has to go more than $95 because you pay $1.85 to buy that call. So it has to go to $96.85 before you'd even. That's buying the call. What we're talking about is selling it to protect your profit here. So if you have an earnings report coming up and you own stock and you want to protect it against some massive decline, here is one way to do it. You could simply sell a call. It's out of the money. And of course, this is simplified. I don't have time to explain what strike price and why and the mechanics of it. That comes with our total introduction to options class, which lasts a month. But you could sell those calls. You could buy these puts down here at 75. So you sold 5 and you bought 5. And watch what your graph looks like now. Now, this is in conjunction with owning your stock. Now your graph looks like this. I'm going to zoom it out. So you're still up here where you made your profit. You still get to make money. This solid line shows, what's going to happen 30 days from now. You still make money if the market goes up, just like if you just own your stock. But most importantly, down here to the left, down at the bottom below this zero line, the maximum you could lose on this trade, let's say Buffalo Wild Wings had the worst quarter in history. And let's say it went down 50 points, or let's say it went to zero, even better. You're only going to lose on your whole trade, $1,100. Whereas if you owned the stock and it went to zero, you'd lose everything you invested, which could be, what it cost you $38,000. So that's the way the graph looks, and it's capped on your earnings too up here. So if I were to superimpose what it looks like with just owning the stock. Okay, I'm going to put another line on top of this thing. And you know what I'm going to do? I'm just going to go to one line. Okay. This purple line represents just what it looks like when you own the stock. We bought it back in August. We're up $4,000. So here's where we sit. If the market continues to go up, we're going to keep making money on the stock, right? On the purple. If it goes down, you can continue to lose money, right? But by employing the options, you turn into this green line. Now, of course, it's hidden in the center here behind the purple, okay? But you can see that it's exactly the same. right in through here. But then it goes flat up here and it goes flat down here. So what you're doing is you're putting together a little strategy ahead of earnings that says, hey, if this thing really hits the skids, I don't want to lose a ton of money, but I also don't think it's going to go higher than, another $10 on the earnings. So it's a way to protect yourself using options in conjunction with your stock. But there's also another interesting thing, and that is that you don't even need to own the stock. You could have this exact same position right here without even owning the stock. You don't even need to own that stock. Basically, if you just did this, sold the calls and bought the puts, you wouldn't even need to own the stock. You could do it just like this. Now I got it backwards. Sorry. What you would do is you'd buy the calls, sell the put. Now watch this graph. Okay. So what if you thought that Buffalo Wild Wings was going to go up, but you didn't want to take a lot of risk in case it went, nowhere to down? You could do this as a surrogate position, and you'll see that basically if the market stays between $75 and $94, you don't make or lose any money. But if it heads higher from there, you make money. Now, those aren't probably the best strikes to use for this, but that just shows you that you could do the same thing as owning the stock, with the calls and the puts. But you also notice that your requirements is only $4,600 versus what's the requirement to own that? $38,000. So that's one way to control your margin. So there's a lot of things that we can do with options once you understand, what the calls are, what the puts are, and how they can work in conjunction with each other. That last example might have been a little bit more advanced. And the strike prices are probably not the best ones to use. You could do it a little bit different than that. But okay, let's see. Got another question. Yeah, great. Makes sense. Okay, well, good. Sometimes I don't make a lot of sense, so it's nice to know that I am at this point. There's other things we can do. Well, I tell you what. Let's get rid of. Let me just get rid of this transaction here altogether. Okay, so now we don't own any Buffalo Wild Wings. All right. Now, I want to point out something important about options. Now, there's things that we use. There's fancy language that we use to describe the factors that influence option prices. And we call those things the Greeks. And here's where they are. If you look right down here, you're going to see we have these crazy names called delta, gamma, theta, vega. Okay? Each one of those is a formula that describes or predicts the behavior of an option. Now, I'm not going to get fancy into that at all with this class, but let me explain why. If you thought that Buffalo Wild Wings at $86 a share was going to go up, why it might not be in your best benefit just to buy these calls. Because a lot of times people, especially beginners, they do this. They say, wow, for just, $900, I can buy 500 a surrogate, okay? The calls equal five of those equal 500 shares of stock. You can say, I can buy 500 shares of stock or control 500 shares of stock for $1.85. And if the market goes up, if Buffalo Wild Wings goes up $4 a share, then, I should be able to make $2,000. Or you think that your call, the price of your call is going to go up commensurate with the amount of the market move. Well, that's not the case because this option does not trade in direct correlation in terms of price movement, does not trade in direct correlation with the movement in the stock. Because if you look at this little number right here under delta, delta describes how much the option's going to move in price for a 1-point move in the underlying asset. The underlying asset in this right now is Buffalo Wild Wings. So if Buffalo Wild Wings goes up $1, this call right here, the price of it, should only go up about 1/3 of that, so about 30 cents. But it may not even go up that much because there's other factors that go into it, such as volatility to affect the time premium and so forth. So you can't expect that these calls are going to go up and down in direct relation to the underlying. They have different characteristics based upon what we call the Greeks. So that's why, as an amateur, you don't really want to just, open, a trading account and get, privileges to trade options and then start buying or selling them because without knowing what you're doing, because, you're going to be mystified as to what happens. But it's really not that difficult once you understand these little 4 things right here, what delta, gamma, theta, and vega are. Once you understand that, it's just like flying an airplane. Well, not that I've ever flown an airplane, but I presume it is that you're gonna fly it based upon relationships. Those numbers are going to tell you certain things about positions. But to get started, you don't need to know a whole lot about that, just enough so that you understand how the relationship works. One of the other most important things you need to understand about options is that options have a time value premium associated with them because they expire. Okay, it's a bet. It's sort of like, and I've never, I betted on college football one time and lost. And that was 25 years ago. But, if you have any idea about betting on football or games like that or horse races even, you'll know that there's odds associated with different, teams. The same thing goes along with options, and this is like this $95 call we've been talking about all afternoon here. That's $10. 95 points is $9 above where the market is. So if you want to bet, and I hate to use the terms bet when we talk about options because really this is a business. It's not really a gambling or should be made light of, but a lot of people associating. So I'll use those terms for now. So if you want to bet that the market's going to go above $95 between now and 30 days from now, why 30 days? Because November has 30 days left to expiration. So if you say, man, I know that I feel that every time I go to Buffalo Wild Wings, the place is packed. I know they're going to have good earnings report. I think the market's going up. So you might decide to buy this call. Well, that's fine. But you're going to pay $1.85 to do it. So the market has to get above $95 by the amount that you paid for the option before you begin to make money. Now, let's say that you said to yourself, well, I don't think the market's going up. I think it's going down. So you could sell that. Let's say you sold that. Well, then you get to capture that premium. Somebody pays you that. And as long as the market stays below 95 between now and expiration, you'll make money. Now, that's a simple, analysis, okay? But that's in essence how it works. Okay, let me see if I've got any questions. Stop here because I've talked a lot here. Um, if you have a question, just throw it in here. Okay, so um, hey, look, I'll show you something else. Let's say that you said to yourself, Buffalo Wild Wings is going to go sideways. So you might could do something similar. Well, actually, I don't have enough strikes. Hold on. There's ways to put a price band around the, or put a band of potential profit around the price of the option, the stock, so that if it stays within a range over a period of time, you can make money that way. I showed you a little bit about that on Monday. Now, let's go back to, I'm going to stop back trader. Okay, so let's go to the current time frame for Wild Wings here. Now, here's the price chart. So if you remember, we were talking about an example where you bought the stock here, you made money, it started to go down and you got concerned. Well, here's the earnings. Poof. Okay, now we're back down to 75. You could have utilized the options to protect you against that move down and not given up a lot of your gains. But had you done nothing and you bought the stock here and it went up, you were up about $5,000. Now all of a sudden you're like in a loss. And who wants to see that happen? So options can be used in a basic way to protect your stocks. But you also don't even have to own any stocks. Let's say say you're like me and you don't own any stocks. Well, you can use options to trade as a surrogate for stocks. I generally, in my professional accounts, I generally trade in the stock indexes, the major market indexes. But occasionally I will trade individual stocks, especially for events, earnings events and things. You might be asking yourself, man, if I want to trade options, do I need to have expensive software? Where do I get, what Tony's got here? Where do I get option prices from? Well, no, you don't necessarily have to buy expensive software. I like to use this particular option view software, and it does cost money, on a yearly basis. But there's plenty of brokers out there that have their own analytical software that you can use. Most notable for most traders that I know of is a company called Thinkorswim. People tend to use their analytics. But let's say you've got an account with Ameritrade. They may not have the kind of analytics that you're going to need to trade options, but you can certainly trade options on their platform. The same with Fidelity. I wouldn't recommend trading options with them because their margin requirements are killer. Interactive Brokers, Trade King. I mean, there's tons of brokers out there where you can trade, options. But for you beginner guys, I mean, that I would tell you is that you don't want to. Excuse me, I had a cough there. You don't want to just haul off and read a book and say, well, now I know about covered calls, because covered calls do not protect you against a market decline. They just give you a little bit of buffer. If the market goes down, there's better ways to do it than covered calls. Takes a little bit more thought and a little bit more knowledge, but still, it's well worth it. So that was Buffalo Wild Wings. And of course, we've got Google, we've got, anything you want, Amazon, IBM, you name it. We also have the major market indexes like, the S&P 500, the NASDAQ 100, and so forth and so on. And we can trade options in those. And of course, in the NASDAQ 100, you can't own the NASDAQ 100 unless you buy it in a fund, like buy the QQQs or like what's called an ETF. But we don't even care about that because we just have option positions and it mimics owning the index. Okay, let's see. I got a question. Jenny says, "Hey, how would you suggest that someone who is just starting out get started? How much money do you need?" That's a great question. Well, how much money do? Let's start with that. Uh, Depending on what broker you're using, what platform you're using, um, you really need it. I'm going to say you need at least $20,000. Now that's not even really a lot of money. That would be the very, very low end. Although you could actually do a ton of practicing with just paper money um, before you actually put your real money up. Um, there's brokers have paper accounts that you can set up where you can actually make trades in the market and get used to how the orders work and everything without risking any real money. And that's of course what I would do if I were just beginning. But you also have to get some education somehow to have it explained to you. Like for instance, I'll just now on the amount of money you need. A lot of people talk about, well, I had a $10,000 account and I, bought calls on this stock and it went up and I made, 200%, in a day or whatever. The way that the professionals do it and the way that I do it is that we calculate our returns based upon our entire account balance. For instance, in my options trading room, I trade 2 accounts live in front of people 3 days a week. One of them has 50,000 in it and the other one has 125. And we try to make 5% a month on those account balances. So yeah, sometimes we may make more than that, sometimes not. But you can't just say, well, I bought a call and spent $1,000 and it doubled and I made $1,000. You can't say you made 100%, unless of course you used all the money in your account to do it, which most sane people wouldn't. So that's how you calculate returns. But you can start with that kind of money, and you just have to trade small. You just have to remember that commissions and slippage on prices affect you when you have a smaller account, and you don't have the opportunity to have multiple contract sizes, for adjustments and things. So in other words, when we establish trades in the market, we don't just make the trade one day and just leave it. As the market moves up and down, we make adjustments to that trade so that we keep our profit zone in line and we do our best to make money. We don't just let it roll and see what happens. I was just going to show you. Okay, here's interactive brokers. For instance, I've had a problem with my market subscriptions today, but this is where's my option trader? There it is. Give me a second, guys. All right, for instance, this is of course the market's closed, so you're going to see some grayed out prices, but basically this is the NASDAQ 100, and these are option prices down here. It looks weird. I don't want to confuse you over it because they're all grayed out because the market's closed. But over here to the left are the calls, and these are the puts. And if you go here, you'll see that around where the market action is today, you'll see that all these different prices. So this is where you get your prices from. These are spreads up in here. I don't want to get too complicated. But you see this right here, November 15th, that little number? Below there is all the options that are going to expire next Friday. So these are the most active ones. And, it'd be nice to see it during market hours so you could see them actually moving up and down and changing prices. But that's how you get it. broker platforms. And we talk about that in our options trading room and our training. Obviously we offer training. This is sort of a lead-in. This little class here is a lead-in into our intro to options class, which takes you through all this stuff in a more detailed fashion. Let's see if I've got some questions. Yes. Yeah, I mean, the thing, okay, so I've got a question here, and it says, hey, if I have $50,000 I want to trade with, can you help me set it up and get started? Should this be money that is completely disposable that we don't need for anything else, meaning will I lose it? Well, okay. Yeah, I mean, obviously when you're trading in the market, it doesn't matter if you're just buying stocks, whatever. Your money's at risk. I mean, it definitely is at risk. The thing that a lot of people find fascinating about options is that options are really the only way that you can definitely define your risk so that you don't have like unlimited losses. I mean, you can certainly trade in a way where you could have unlimited losses, but we never recommend that. So there are ways where you can cap potential losses, but yeah, it has to be, money that wouldn't, change your lifestyle if you were to lose some of it. But that's where good training comes in, good understanding of, what to do and discipline. And it's not really that easy. It's a journey. You have to start somewhere. You got to learn a bit, get the best understanding you can, and then determine if it suits your particular personality, or if it's better. If you're better off letting a professional handle your money, which a lot of people are. There's no harm in that. But, a lot of people want to be a little bit less dependent on others, and they want to be able to try to make a little bit of increased return, with some safety factor, and trade within reason, and there's ways to do that. And that's the way we approach the markets, because that's the only way you can stay in the market and be consistent over a long period of time, is you have to manage your risk. And that, everybody talks about, manage your risk. Well, it's one thing to say it, it's another thing to actually do it. And there's ways that you have to do it. You just can't get greedy in the market. You have to realize that it's a business and you have to operate accordingly. Yeah, so some people want to know about the trading room. Well, the trading room that I operates Monday, Wednesday, and Friday of each week, and that's where I trade my positions live. You get to see exactly what I'm doing on all my trades and how I operate in markets like today. I mean, the markets were down hard, right? Well, I closed my NASDAQ position yesterday. We made 4% on it in 13 days, and that's 4% on the entire balance for our portfolio margin account. So we made about $4,900 on that trade over 13 days. We still have a Russell position, so you get to see what I trade. So it's a good learning experience. The options trading room is not necessarily for ultra beginners, although you could certainly get up to speed pretty quick with it. But if you have a little bit of knowledge about options already, I would recommend you giving it a try. And we'll get to that on Friday. Probably give you guys some kind of a discount and a special offer for a month to look at it. Or the beginning class, if you want to move on, if you decide it's something you'd like to do and investigate it a little bit more. Be happy to do that. Okay. We've been going for about an hour. What I'm going to do is I'm going to pause I'm going to pause here for a minute. I'm going to mute myself. Formulate if there's any final questions or anything like that. I'll give you my email address again, and then we'll have another session on Friday. But if there's any more questions, I'll be happy to hang around. Because I know some of you guys have different levels of expertise. Some are very, very beginning. Some have a little bit more knowledge. So I try to cover it all. But let's take a break for 2 minutes. Grab yourself a moon pie and an RC soda if you're so inclined. I remember a building inspector used to say that when I was building houses years and years and years ago. He used to always say, hey, I'm here to do the inspection. He says, why don't you go grab a RC cola and a moon pie and have a seat, and I'll give you my long list of deficiencies before I leave. Hilarious. Or a cigar. Yeah, exactly. That was more like it. That's what I should have been doing. Okay, I'll be back in 2 minutes. We'll answer some questions then. All right, well, we don't have any real questions, so I guess I kind of covered it there. Again, if you guys want to hit me up at support at, let me just type this in here. Get my email address in here for you guys. Okay. Yeah, if you got any questions, send me an email. I'll try to do my best to get back with you as quick as possible. So anyway, okay, what's the bottom line with learning how to trade options? Well, in all seriousness, there's a lot of information floating around out there. You really need to really get an understanding of kind of what you're doing before you really trade real money. And you got to have some kind of an education, involved in that, no matter what it is. And there's ways to make it. There's tons of things you don't need to know about options. Like there's tons of things that I just ignore because they're not really pertinent to me and the way that I trade and my clients, the customers, the way they trade. So I try to cut through all that fat and get down to, the essence of it. And we try to make that as simple as possible. So, yeah, I mean, there's got a question here. It says, is there anything I can read to learn the basics? Yeah, I mean, there's plenty of free, basic material out there, but it's kind of cut and dry. It doesn't really take, it's a lot of theory. It doesn't take into account like the real trading that goes on. There's free sites, the CBOE, places like that. You can get. But my advice is if you can learn from a real active trader, it's probably better. That's how I learned. I mean, I read books. Shoot, I'm sitting here looking at on the wall right here on my bookshelf. I've probably got I don't know 25 or 30 of them over here, but they didn't quite cut the mustard. I mean, where it really started taking off for me years ago was when I started learning from people that actually trade, see exactly what's going on, not just written material. And with the advent of the internet and the way we can trade these days and teach, it's so much more interactive than a book. Yeah, we've got a lot of free videos. I mean, you can go to our website, paw around through there, and get some free stuff. And like this free, the free webinar I'm giving here, interesting ways to learn. So. Yeah, it's another good question. I mean, you don't have to be a full-time trader to do it successfully. I mean, I know a lot of people that have a full-time job and trade. I mean, that's why options are so good, is because they give you a lot of flexibility. You don't have to sit in front of your computer screen all day. You're not day trading. These are positions that we set up and then we manage them over a period of time. and you don't have to look at it all the time. Especially in the options trading room. I mean, crap, what I do is I handle it for everybody. I mean, I'm the eyes and ears of the market, and I'm at my desk every trading day from opening bell to closing bell, and trade. So that's one thing to keep in mind. Okay, guys. Well, I will make sure that I thought these recordings would be an email to everybody, but maybe not. I'll have to check into that. But if you do want it sent to you, I'll send you a link. Just shoot me an email, at support@optionelements.com, and I'll make sure it gets out to you. Actually, you know what? We're in the process. I forgot about this. We're in the process of redesigning our website, and we're almost finished. And I think that's why they're not on there. There's going to be a section for all these public videos and webinars where you can find it. Just don't know how many days it's going to take. I need to call Carl in Germany and find out. Okay, well, listen, I want to thank everybody for their time today. Send me questions if you have them. We're going to have another class on Friday, just to follow up, talk a little bit more about how to get into options and answer any and all your questions. So that's an opportunity for you guys to ask any question you've ever wanted to know about options, and didn't have anybody to ask. So I'm your guy. Okay, I'm going to cut our recording off now. And again, I appreciate everybody being here today. And if you have any questions, let me know. And otherwise, I'll see you guys on Friday.